Hello, everybody, and welcome back to the M3 Market Update. My name is Melody Wright, and I do this show to give you context around the information we're receiving regarding commercial and residential real estate. Welcome back. And I owe you guys a serious apology, even though people tell me I apologize too much in the comments. I say, have you ever met a Southern lady? But anyway, I apologize for apologizing. But my long absence, some of you may know, was because I had to take a little trip up to see Mr. Charles Payne for a segment in New York, and it really threw my schedule off. So I just want to say I'm sorry. Got a lot of things going on with DNN, with the Forgotten American, but I don't want to ignore you folks. And you're going to get this update today because I've been able to look at my cities with the Redfin results, and I have some information to share with you. But you'll get another video this week after we get new home sales on Friday. We'll get existing home sales tomorrow. And so I'll do a follow-up video. Right now, I am forecasting for existing home sales a non-seasonally adjusted number of 385,000. And I do believe that they're going to be up both year over year and month over month. And that's going to be largely because they'll use those seasonal adjustments. And there were extra days in July from both the year over year and month over month perspective, and we'll go over that. But first, today is August 21st, 2024, and we got some breaking news. Today, we received the quarterly revisions to the establishment survey that the Bureau of Labor Statistics does. And they revised March, our Q1 of 2024, employment numbers down by 818,000. And I believe the largest category was professional services. Guys, this is a huge revision, and it just goes to show you that the excitement and the narrative out there is often around fake information. And is it fake on purpose? Is it fake, unintentionally? It doesn't really matter, does it? But that's why I do this show, so that you guys can triangulate the data. We can look at, more of a 360 view instead of just one number to get a sense of what's going on. And so what I try to do is give you the unvarnished truth. Whatever the data says, I'm going to tell you. I'm just going to give you a whole bunch of data points for you to consider. Because, I think those of you that have been watching the show would not be surprised by those results. But what I want to talk to you about today, there's a lot going on. And first, let me start, because I haven't talked to you since this happened, but we have seen rates sort of go down. They definitely have gone down, mortgage rates. And, the mortgage industry got really, really excited at first because we saw a huge surge in refinance applications. I wrote a Substack that was called Carried Away, and I did a deep analysis of the, about 68% of the borrowers that are sub that 4.5% interest rate, and the others, what rates would have to do to get material refinance activity. We will definitely have a refi boom, but that is not for a good reason. It's because consumers are completely tapped out. And then those who really do want to take advantage, they need rates to go a bit lower, as well as they don't qualify. Their credit isn't good enough. And so, guys, we will see a refi boom, but it's not going to be massive unless we see the rates drop precipitously. And that would mean that the Fed or some buyer of mortgage-backed securities would have to come into the market. And for those that have been following me on DNN, and I would encourage you to watch that weekly broadcast there, that what's actually happening is it's much more likely that the foreign actors may stop participating at the scale that they have been in the bond markets, as they have to repatriate cash home. And so it could be that we don't see mortgage rates go down significantly the way they've done in prior episodes. And so, but we're going to keep track of all that here. I will keep you up to date and let you know where I think things are going kind of directionally. I follow Eurodollar University. Another thing that's going on is what is called the September effect. You can go check it out there. But typically in September, that 10-year does seem to rise. And so for everybody that's looking for rates to just drop, like a stomach drop right now. I don't think that's going to happen, but stay tuned. We'll keep tracking it. Okay, so what I want to go over today, and I know a lot else has happened in the past couple of weeks. I don't even think I talked to you guys since that big market drop, with the carry trade. I hope that you guys were able to see that on DNN and what we talked about there. But again, now that the crazy summer is over, hoping to get into a true routine and get these videos out to you weekly. And I will apologize one more time. Sorry, guys. Okay, so I'm going to share my screen and just go over quickly today these initial Redfin results. And so for those of you that are new to my channel, I track about 82 markets in terms of, what's happening from an inventory perspective, from, sales, price, rental listings, short-term rental listings, all kinds of good information. So, but here we go. This should be coming up shortly. Okay, excellent. And hopefully everyone can see it. I'll try to make it a little bit bigger. Okay, here we go. All right, so for July, and again, 80 plus cities that I track, and I use the Redfin data that's publicly available on the data tab in their website. You can just Google Redfin data, and you take my cities, and this is what we're looking at for sales and price information. So for July, sales for M3 cities were up 4.26% and 3.63% month over month. The 25-year average is a decline of 4.71% month over month. So I think a couple of things are, as you guys know, I've done a 25-year seasonal analysis. And what I think there are a couple of things happening. One, we will not know for some time, but what we need to realize, there were 3 extra business days in July, this July versus June of 2024. So month over month, 3 additional business days and 2 more business days versus July of 23. Is that all of the difference? I don't think so. I think that's some of it. I also think we might be breaking seasonality here in terms of motivated selling. This we won't know for a couple of months, and I could be wrong on this, but we're going to keep watching this. So again, sales up both year over year, month over month. Like as I say, I think we're going to see about 385,000 non-seasonally adjusted in existing homes. You guys know I track combined homes. So then when we get new home sales, and my colleague, Mr. Awesome, believes we're probably going to get at a 53,000 new home sale number, which would be about what we had last month. And that would track with what we're hearing from the Zellman survey and other builder surveys, that traffic was down, transactions were down, incentives and price cuts were accelerated. So we'll see. But if that is the truth, then we're going to have a really historically low July. Again, we're tracking right now in terms of sales on an absolute level below 2007, below 2008, 9, 10, 11, et cetera. For the season, guys, for the season. I'm looking at specifically those comparison points to the months in those years. Okay, prices. We know prices were up. We've seen this. They were up 3.58% month over month. Oh, I think I have this backwards. Sorry, guys. They were up 3.58%. I'll change that on the slide year over year, but down 1.97% month over month. The 25-year average you would see from June to July is a negative 0.22% decrease. And so you can see that prices are coming down faster than the average on that month over month basis. Just for perspective, during 2007, sales decreased 6.90% from June to July, and prices increased 2.14%. So in 2007, sales decreased month over month, but prices increased. It sounds very similar to what we're seeing what we have been seeing previously. In 2008, sales decreased 1.07 from June to July, and prices decreased negative 0.48%. Okay, so that just gives you a little bit of context of what was happening during, kind of the years running up to the housing crisis. Inventory was down 1.46 month over month and was up 27.10% year over year. So what I will say here is you're definitely seeing inventory slow in all the markets. This is, again, school is starting. School starts different times here in the South. We start very early. Out west, they start a bit later at the end of August. And then on the Northeast, even later still, they start in the beginning of September. And so we definitely have different seasonality all over the country. And what I'm going to be doing in my Substack is probably showing that tomorrow, some comparisons of what, seasonality is. For instance, we know in Florida that their season starts in October. And so as we've seen inventory slowing in Florida, I expect we'll start to see it increase again in October. The other analysis I'll be doing tomorrow in depth is looking at where we're not seeing slowed inventory. And some of these places are crazy. Asheville, Honolulu, Las Vegas. And so we'll be looking at those markets that really are acting out of season, okay, for signs of distress, because that's where we're going to see the cracks and what's happening. And nothing has changed. I still believe we have hit an inflection point. I can see it in the delinquency metrics as well. I'll talk a little bit about those here after I finish this update. But the other thing here is average days on market increased by 3 days to 42. So we are definitely exiting the season where we're seeing accelerated activity out of season is going to tell us a lot about the market. And I just want to one market that I was just looking at because I also pulled delinquency, and in my Substack tomorrow I'll give the full breakout of all of the 80 cities, their prices, movement, inventory, as well as delinquency. I'm also working on an analysis that's going to look at delinquency and every percentage of delinquency, what shock that has to home prices, if any. I know from my experience that definitely has a correlation, but I want to get some precise numbers around that. For instance, one market was very interesting, where very tight market, Richmond, Virginia, not the metro, just Richmond, Virginia. You can pull it on Redfin. Essentially sales were just fine, but prices were down. And this is a tight market with only 12 days on market. And so I think that is some signs of some early trouble there. And their delinquency is also elevated above the national average. I know that national average is about 3.68%, and they were over 4%, I think 4.3. So, it doesn't seem like a big difference. But most of my cities, believe it or not, are below that average from a delinquency perspective. But these are the kinds of things we're going to be looking at to try and forecast where prices are going in these 80 cities. It will not be exact, but it should be able to give you some direction. So hopefully this little update is helpful. There has been a lot going on. It's almost too much to keep track of. We're going to get some data here soon to show us where we're going, but I don't believe the path has changed. I think we have turned a corner. Let me update you just a little bit on those delinquency figures. As you guys know, I came on talking about that really large increase in delinquency from Black Knight. They blamed it on the calendar. I said, that doesn't make sense. March ended on a Sunday as well as I was looking in my own books. I think even when I talked to you, I told you that I had seen some improvement in my own books, and that is still true. But what happened? It is still elevated. That 30 plus is up 8% from May. What I saw when I did loan level reviews is I saw many people getting swooped up in what's called a simple repay plan, as well as the partial claim for FHA. And for those of you that don't know, the partial claim essentially takes all of your delinquent payments, and you can put that in one lump sum and put it at the back of your mortgage. And so with all the loss mit programs out there, guys, you've got two populations right now. Because we have had 4 years of loss mitigation. We had over 1.8 million people take a payment deferral for Fannie and Freddie. That was taking 18 months typically. It could have been less, but putting all those forborne payments at the end of the loan. So we have had massive government intervention already, which has saved so many people. But what you're seeing now are the folks that they've taken every workout, the 40-year mod, the partial claim, whatever, the forbearance, anything they possibly could have done. They've been trying to sell their house. They cannot. that delinquency, they're losing jobs. That delinquency is getting stickier and stickier, and they have no options. And for whatever reason, they weren't eligible for home ownership assistance funds, HAF funds, or they had run out in their state, although most states still have more than half of those funds. On the other side of it, you have new delinquency. Again, that increase from May to June in 30 plus delinquency was over 19%. You don't see this happen. It is very rare. And essentially, you're only moving not even a full percentage point in delinquency month over month. So that was an inflection point, but they quickly got scooped up by the servicers, because those servicers have to act very quickly to get them on some sort of plan. Now, a lot of times what will happen is people won't call in until there is no other option, and they get that notice, that breach letter, or that notice of foreclosure. And again, it takes 120 days before you're allowed to refer someone to foreclosure. And now the CFPB new rules they're asking comment on is essentially you have to review them for all loss mitigation options before you do that as well. Now, that's already really happening, to be honest with you. But it is, the one thing the CFPB did for the mortgage industry back then was kind of limit the need to constantly do the reviews over and over and over, and gave it a timeline, and said you have to have a complete application, because basically what was happening during the GFC is someone would call in and say, I want loss mit, and per our consent orders and everything, we had to stop everything, review them again, even if nothing had changed in their financials. And we reviewed some borrowers hundreds and hundreds of times, and because they realized it was just a way to stop the foreclosure. And the CFPB came in and said, well, actually, they have to have a complete application before you review them. Well, these days, guys, you don't even really have to have an application. They send you the modification in the mail. Now, don't take this. If you are in default, don't, call your servicer right away. That is not what I'm saying. But these are streamlined. They often don't need your financials. They'll just send it to you. They'll make the offer to you in the mail for you to take it. You can make that first trial payment. And really, that's what these new CFPB rules are doing, is just kind of standardizing what's already been happening during COVID, which were extraordinary relief options that no one had ever seen before. So for delinquency to be going up right now, with unemployment where it is, it does not make a lot of sense based on the massive intervention that has already occurred from loss mitigation perspective in the housing market. But this is what we're going to watch closely, because it's going to be that sticky population that keeps growing, the ones that already have had these modifications, already, to avail themselves of the forbearance, avail themselves of the payment deferrals, and they're turning around the market and trying to sell, but they simply cannot. And so for everybody that said everybody has a ton of equity, that equity is only there once it's realized at sale. And that is what everybody needs to understand. But so many people out there in our mainstream media want to push the wealth effect and essentially make us feel wealthier so that we sell our souls into debt slavery. And guys, I just would encourage you, if you're thinking about buying a home right now, please, be very, very cautious. We are at a point where sentiment has changed. The University of Michigan survey, sentiment for home buying is at the lowest in that series. And therefore, you're wading into a pool where the sentiment has started to turn. And typically, guys, this just picks up momentum to the downside. And so, this AI, I believe we have a bubble in the stock market. And I believe as well that sentiment is slowly turning there in addition. And so remember that the beginning of this year, we had very much positive sentiment coming from what was happening in the stock market, but that really peaked out so far in June, as well as we have had some very turbulent political and geopolitical events here. So lots going on. This isn't the time, in my opinion, to be making decisions, that could impact you for the rest of your life, because honestly, what's going to have happened to so many of these people that bought in 21, 22, 23 is that they are going to erase their future purchasing power. FHA delinquency is at 12.1% last month. And they are 16% of the market, 16%, much lower back during the GFC. And so you add on that non-QM of 5%, that gets you to 20% of the market has increased delinquency. So guys, buckle up. This is the time, all of the work that we have been doing, all of this data that I have been tracking, this is when it matters, because now we have a firm foundation to really watch as this market changes. So my apologies for not doing one of these in a few weeks. Hope you forgive me. And I hope you've checked out some of the other great content that we've been putting out at DNN, Doomers News Network. I'll post the link here in the show notes. But as always, everything that I do, including getting to go on national TV, is because of you guys and the support that you've shown me. And so I'm eternally grateful. I'm eternally grateful for the information that you share with me. So please, give me that local intel. I'm behind in comments. I hope to get caught up soon. But thank you again for watching. And I'll see you in a couple of days when we get those existing home and new home sales. It's going to be, as I often say, very interesting. Thanks again, guys. Have a great day.